So let's talk about the different ways that you can actually invest your money, build your wealth, and build true generational wealth. So this is the money that you put aside to invest. This money can either be automatically invested or you can manually take this money and invest it somewhere. And this is going to depend on your investing strategy and your investing goals. So let's break that all down. There are 3 questions that you want to ask here. Number 1, what is your investing strategy? Number 2, what is your investing goal? And number 3, which assets are going to fulfill the strategy and goal? So let's break this down, starting with what is your investing strategy, and you have 2 options. You can be what I like to call an active investor or a passive investor. Now, an active investor is somebody who is going to be more manual and more involved with their investments. Think of this like trying to find a good stock to invest in. Not trade, but invest in. You're trying to find the next hot stock that you want to own for the next 10 years. Or this could be something like you want to go out and invest in real estate, so you're going to go out and find a property to purchase. That's active investing. Passive investing is you want to set it and forget it system. You don't want to be involved. You don't want to read financial statements. You don't want to have to go out and talk to tenants and property managers and deal with the city hall and all that. So now, to be a passive investor, you can invest in the stock market by investing in funds. ETFs, mutual funds, and index funds. That way it's passive. It's a set it and forget it system. Your money's automatically invested every week or every 2 weeks or every month, and you set it and forget it. Or when it comes to real estate, instead of you actually operating the deal, you're just going to invest in somebody else's deal. You hear of an investor who's looking to go out and buy this big apartment project, and you can invest some money into it, so you're a silent investor. Or you find some crowdfunded real estate deal online, and you put some money into it, and you let somebody else operate the deal. Now you're a passive investor getting exposure to real estate, but you're not the one that's actually operating the deal. That's passive investing. And you got to decide what's right for you, or both. For me, I'm an active investor and a passive investor. Now, I don't recommend what I do to anybody else. I'm just a random guy on YouTube, okay? Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But for me, I like to diversify against myself. So I have a passive strategy where I invest money into the stock market passively. I have a portfolio of funds that I invest in. This happens every week, whether the market's up or down, and it does not matter. I also have an active strategy where I'm actively investing in real estate. I'm actively looking for stocks to invest in. I'm actively investing in startups. So you have to find what's right for you and build a system around that. Once you understand your strategy, the next question is, what is your goal? More specifically, would you rather see cash flow or would you rather see appreciation? Now, cash flow is when you're going to go out and you're going to buy an asset and it pays you for owning it. So when I go out and I invest in real estate, my goal is cash flow. When I buy this property, and then I want this property to pay me every single month, and then I want to use this rental income to pay for all the expenses, and then have some profit every single month. This way now I can work to stack the cash flow, and I can live off the cash flow. It's the same thing in the stock market. When I invest in stocks, the bulk of my stock market portfolio, the bulk of my passive investments are passive for cash flow. So these are funds that pay dividends. In the stock market, a dividend is when a company has a big profit and then they just pay you this cash for owning that stock every 3 months, meaning every quarter. So now, every Wednesday, my money is going to buy these funds, and then every quarter, these funds pay me with cash flow. And then when I get this cash flow, I can choose to either reinvest the cash flow to buy more of these cash flow producing funds, or can I use these funds to build my savings or to go out and spend. And for me, my goal is this cash flow, because when I think about generational wealth, I like this idea of owning these assets which spit out this cash flow. That way then I could potentially pass down these assets to somebody else, but that cash flow continues coming. Appreciation is you're buying something and then it goes up in value. And then when many people think about selling or retiring, then you start selling some of these assets. That way you can start to realize that appreciation. So you buy a stock for $100 and it goes up to $1,000 a share. Now you can sell that, pay some taxes, but now you have this cash that you can spend, and now you can use this appreciation to live your life. You have to decide what's right for you. For me, the bulk of my investments are for cash flow, is because I like investing for cash flow, but a lot of people don't like cash flow because it can be a slow process. But for me, that's what I prefer. I want to work to stack the cash flow so I can live off of my cash flow, because that way this cash flow can keep paying me and I can keep spending that money. And well, that's a very nice thing to have when your cash flow can pay for all of your expenses. And then the third thing you want to think about is, which asset do you want to invest in? Now, the 3 assets that have built more wealth than anything else over the last century are building a business, investing in stocks, investing in real estate. There are many types of assets out there, but those are the 3 that have been time tested and proven. And so as you think about now where you invest your money, you might look at startups, you might look at alternative assets, you might look at cryptocurrency, you might look at a lot of things, which is fine, but start with the things that have been proven for the test of time. So now you can decide, well, if you want cash flow or appreciation, what is better? Is it stocks or real estate for you? Which one's going to allow you to be more active versus passive? Again, stocks and real estate can allow you to be more of an active investor or a passive investor. You just have to decide now what is right for you. Now that you've built a financial system and now that you know how to invest your money, let's talk about how you can spend your money smartly. This is where you really want to understand the difference between an asset and a liability. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. You buying food is a liability. You paying for your house is a liability. Your car is a liability. Your vacation is a liability. Now these things might be necessary, but they are liabilities. And this is where I want you to focus on buying the assets before the liabilities. But the reality is you gotta have liabilities. You gotta eat. You need a roof over your head. You need a car. You have to buy things. And this is where you want to be able to control your spending and be smart with your spending. And what I mean by that is if it doesn't put money in your pocket, if it is not an asset, stop financing it. This is one of the key drivers of building wealth for the average person and even the wealthy is you buy things that you can afford, period. If you don't have the money to buy it with cash, you can't afford it. The exception to this is your house, but your car, your vacations, that Gucci purse, if you don't have the cash to buy it, don't buy it. Wait until you can buy it. And this is difficult today because I know in today's culture, it's super easy to buy things with buy now, pay later, with 0% APR, with a whole bunch of credit cards. I mean, it's very common. Everybody does it nowadays. But if you don't want to live like everybody else, you can't keep doing what the majority of people do. I mean, this channel is called the minority mindset because it's all about thinking differently than the majority of people. And if you keep doing what the majority of people do, you're going to end up like the majority of people. And unfortunately, that means you're going to be fat, unhappy, and broke. You don't want that. And so if you don't want to do what the majority of people do, you can't keep living like the majority of people. That means you got to stop financing things. And then if you want to take it one step further and be more aggressive, one of the things that I like to live by is the rule of 5, which says if it's not something that I need to survive and I can't buy 5 of them, I can't afford 1 of them. This way, I know that when I want to buy something nice, I better be able to afford it comfortably so I don't have to worry about the price. That way, it doesn't dig into my actual ability to build wealth. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.